So we've got our counter trend move, but is it time for earnings season to send us right back to the downside? It starts to look that way with Meta down over 10% on their announcement after the close. But it's more than just earnings, the data still leans bearish at the sector level and beyond. So let's build a game plan to handle that reality. As always, check out the links listed down below in the description, hit the thumbs up button and subscribe for 100K by May. Looks like we'll be a little bit short there. And stay tuned until the end of today's show. We've got 3.5 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off with a closer look at the SPY daily time frame chart. What do we see here from a trend perspective? Certainly sitting in an overall downtrend, and we're moving from the lowest low in search of a lower high on the daily time frame, right? Ultimately, the trend will remain down as long as we can find a lower high anywhere underneath the weekly line in the sand at 512.50. This is the first time that we've seen an hourly counter trend move in the upward direction ever since here, before the market had aggressively broken down from the Monday session of last week. So overall, it's not likely that the daily trend will change into the end of this week. I would actually make the argument that the lower high can be found directly here at 506. Not only is it loosely the upper edge of this week's expected move, so it checks out from an options risk perspective, right? But we're also opening on the intent of a small gap down as of right now based on Meta's earnings. So the bid-ask spread in the post-market is 501.75 by 77. That puts us well underneath this sort of 503 level, which is the low of today's session. So the only reservation I would have about saying, oh my goodness, let's prepare for a lower high, is the daily structure, right? We've printed out a daily hammer candle here, where in the lower wick, we can see or assume that buyers stepped up and they were able to close near the highs, the upper third of today's trading range, certainly near the highs of Tuesday's trading range, even over the upper edge of the weekly expected move. However, with this intent of a gap down, now we can start thinking about a reversal underneath 503, rejecting today's low of day into the end of this week, starts to suggest that buyers are trapped up here, right? And this is nothing more than your daily lower high. The other really interesting component to sort of acknowledge and understand is that we had thin structure over here. These were a string of single prints over on the market profile over the Tuesday high of last week. Wednesday high, it was a 2-day high. This was thin structure, and ideally, if the buyers were able to breach 506, we were looking for at least a counter trend move into 509. So is there any suggestion of stronger buyers other than a counter trend move off of the lows? The answer would seemingly be no, and I can actually just show you the market profile right now. Look at this level. It's a shelf, right? You can see that above the shelf, this brick, single brick, represents single prints, right? So over that number, which was 51.2425 in the ES futures, we should have been looking for a closure into loosely 51.54. We've been talking about these levels in the pre-market prep. So that did not take place, even though the high of day today breached and got into the single print zone. There was no acceptance inside of that level, which to me is an indication that we absolutely do not have stronger buyers entering this market, right? And we'll see some conflicting data points on the market internals in just a second, but the premise still stands where if we can open underneath today's low of day for tomorrow morning's open, and value tomorrow develops underneath today's trading range, that to me is a hallmark indication of setting just a lower high on the daily time frame chart, right? It's a rejection, it's a failure from the buyers to rotate through thin structure. If we go back and over to the platform, that would be an open underneath here, rejections, then looking for continuation in the downward direction, ultimately into the equal low. That's ideally what the downtrend would resolve as, right? An equal low down here at 494.25, and then we will reassess equal low breakdown versus the indication of a possible, obviously very, very speculative right now, double bottom. So high-level takeaways on the daily time frame chart are going to be that if we open on a gap down tomorrow, it leaves room for basically this to act as your lower high. If we open over 503, I would be very interested in, because again, there's a lot of time between now and 9:30 when the bell ultimately rings tomorrow morning. If we open in here, I would be open-minded to the counter trend move continuing into 509 and then just once again looking for a rejection off of that level. Is it possible that we close the thin structure and still get a lower high here? Absolutely. If you're counting trend, remember, this is an hourly uptrend, this is an hourly uptrend. This is the first hourly uptrend, meaning that a lower high can be found, I mean, like we talked about on the weekly chart, right? Anywhere up against 512.50. So 509 is great because it keeps us underneath the daily 50 SMA. That would really be the next spot to be watching watching out for here. If the market is going to make a stronger move in the upward direction, obviously we've talked about how this needs to be the recapture. Seems like lower odds into the end of this week. Here it is on the hourly time frame chart, right? So as you can see, any open inside of, or I should say over 503, under 506, puts us inside of consolidation for perhaps what starts to appear as a bull flag from here up to here, right? That would get us over the 38.2 bullish consolidation. Great. It's a flag. We'll look for the breakout. And again, it's just a counter trend move into 509. We're not overstaying our welcome on the long side at 509, considering all the data points we're about to discuss. So that's your upside if we open over 503. If we're opening under 503, right? What's the idea? Any lower high rejections on the hourly chart set this up as nothing more than just a double top rejecting the neckline, right? So here is your double top opening on the gap down tomorrow morning, puts us here. Rejections of the neckline at today's low of day, 503. You start to look for trades in the downward direction. First stop down here at 499.50. It is these equal lows from in the past, which obviously broke down. It's also a high from the Friday session of last week. And then beyond that, it's the equal low that we were just describing around 494.25 on the daily time frame chart. The other thing we can do is really come in with a Fibonacci from the top of the Monday session of last week, do something that looks like this, and notice that today's session, it's a rejection of your 61.8. So from a Fibonacci point of view, we always know that staying below a 61.8 dramatically increases the odds that the bears remain in control, and if we get over the 61.8, the odds would increase for a 100% retracement. Again, with Meta gapping down and putting downward pressure into the markets, doesn't look likely that a strong recovery of this 61.8 is imminent. So bearish data points so far when we consider what's going on with the Meta gap down. Let's bring out some anchored view apps to just reinforce the levels as well. Here you have your 509 that's anchored to the Thursday, the first initial liquidation break. Oh my goodness, panic, geopolitical risks. That day, that anchored view app is at 509. So is it possible that, again, based on volume, this is a substantial place to be looking for the lower high? Absolutely. Checks out as a reasonable location. 503, if we open on a gap down underneath it, it's a rejection of the Monday anchored view app as well as the Monday anchored view app from last week. So resistance, right? Looking for a move in the downward direction. If we end up opening in this range, once again, I would be very open-minded to this as a possible idea, but it's certainly a lower tier idea as of right now, given the data points. So let's take a little bit of a look at some conflicting evidence here, which actually is the market internals. We did see strong volume inflows on Monday and Tuesday, notably Tuesday, up and over 300 million here. Today was neutral. I wouldn't really call it much of an aggressive read out of the volume flows today. The breadths were mostly at parity for the duration of this week's session. One of the interesting notes here is that the index score has actually been really strong. And one of the things I want to at least balance out here is that the index score is extremely helpful intraday. I'm not saying that it's a bearish data point. Like, please don't get this twisted. I'm not trying to shift it. So, oh my goodness, he's trying to make something bullish look bearish. Not the case, but this measures from the opening print. So understanding that, I would sort of think about what's likely to happen tomorrow from the opening print and whether or not that's going to be bullish or bearish. So yes, on the move higher on Tuesday, I would argue across the market, it was a very good day to be long, and this proves that. Today, mildly decent day to be bearish, right? And we got a lot of chop. It was back and forth, but it was a better day to be bearish, right? Looking for that lower high. So I do want to acknowledge the strength of the buyers in a couple of these instances. You can see that the cumulative builds here as well, pretty solid, up around positive 5,000, but I'm not necessarily convinced it means we have anything more than a counter trend just yet. Could it develop into more? Yes, but with the intent of a gap down underneath today's low, I'm not confident in saying that we're about to just flip-flop back and forth and suddenly start calling this a daily uptrend. We're just not there yet from a data point perspective. So those are your internals. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner really briefly, but I do want to go back out and show you a couple of other really interesting charts here that sort of tie directly into the S&P. So first of all, let's take a look at Visa. They reported earnings after the close the other day, and you can see the large gap up, right? So sure, on this morning's open, the market was slightly more bullish than bearish, but notice what the gap did all day. It faded right back down to these lows. So was any of that bullish progress really realized? I think the answer is no. So Visa's not the only one. If we look at Tesla, and we'll get into the core list of companies, of course, I mean, it did gap up and it's holding some of the gains, but it's not like we saw an advance out of Tesla intraday that held, right? So that's another one. Meta, we know, is gapping down. BA is another one that gapped up. Not that it's overly helpful for your S&Ps, but if you're thinking about the components which maybe made the market slightly more bullish opening near the highs of the previous day's session today, Boeing didn't hold. It closed extremely weak, huge bearish engulfer. This could actually probably be a bearish trade idea looking for downside. I'm going to leave it off the radar today. It's not part of the 3.5 ideas. And then TXN is another really interesting one. So obviously Texas Instruments having to do with semiconductors and the AI space. You'll notice that it gapped up. It's holding some of the gains, but it faded from the day's session. So if this is to continue in the downward direction, once again, why was the S&P opening somewhat strong today near those highs on a small gap up? It was because of those select few names, and as of right now, those gains are not holding, and we're actually seeing a move in downward direction based on Meta. So once again, when I'm thinking about how all of these things come together, I'm not necessarily convinced that we have this strong bullish, counter trend move that's going to turn into more than a counter trend move. And another great illustration is just jumping directly into the QQQ. So in the tech side of the market, QQQ daily time frame chart clearly in a downtrend, right? We've broken down from this as an overhead balance range. There's certainly an opportunity for any lower highs to be found underneath 433.75 on today's session. And once again, I would use the same approach as what we've been talking about for the metaverse, right? In the after hours, we're 420.50 by 60. Right, on the bid-ask spread here. So that puts us, down here, certainly the intention of a gap down for tomorrow morning's open. Could this be the daily lower high? It certainly it seems like the answer is yes, right? So a couple of ways to actually trade that here out of the daily time frame chart. Opens underneath, rallies and lower highs rejecting, previous low of day, gap fill reversal underneath 423.50, trade back down into 418 and then trade back down into these equal lows, ideally looking for this thin structure retracement from back down here into this level at 411. And 411, as we know, is a weekly area of support. So we have to traverse some time frames here out of the NASDAQ just because this structure is a little bit more top of mind, right? I don't know that even if we were to trade all the way back down into the equal low, I would be an aggressive short on the lows. I think the time to be short, so understand that this is the picture, right? From the weekly perspective, you don't want to be a new money short at a previous area of resistance, which now has the opportunity to act as support. That's the illustration. Let's go back down to the daily. The time to be short is on the gap fill reversal here. So let's just say that we get this tomorrow to trade into this location. The idea is not to be a short here, it's to be a short up here, right? Because the risk reward is just far superior. You can go stops here, entries in here with targets loosely down there. That's generally the range that you would be trying to travel, right? So in my view, the QQQ also is a sign of weakness, right? Because the tech sector is the heaviest weight component of the S&P with a huge offer. Like there's nothing about this chart where on the daily time frame we can say, okay, this is constructive and we're starting to look for a move back in the upward direction. It's just not even close, right? So indecisive doji, a little bit more bearish here. It's not as hammer-esque as what we saw out of the S&Ps. And once again, your idea is gap fill reversal. Let's actually take a look now on the hourly time frame chart. Taking a closer look over yonder, we'll come in with the same Fibonacci's from the low of the Monday session up to the high of today. So once again, we are opening underneath today's low, or at least that's the intent as of right now, 420.75 or 60 by 80 right now. So we'll be somewhere in here, right? So gap fill reversal keeps us underneath the 38.2. We're falling out of very classic bull flag consolidation zone. It's kind of off the table as a target. And again, the prevailing winds are in the downward direction anyhow. If we come in with a fib from the Monday high of last week, which is really where the breakdown began and accelerated from, you'll notice that this 38.2 is actually identical to the level here at 423.50. So opening below keeps us in bear flag consolidation if you would actually like to consider it from this point of view right here. This makes a lot of sense in that sense, if you will, as a daily lower high. You'll also notice that the upper wick, although not perfect, is a rejection of this 61.8, which once again, what did we discuss? If we're over the 61.8, the odds increase for a 100% retracement. If we're underneath, the bears remain in control in the case of a downtrend, right? The other thing to point out as well, and let's just go back to the daily chart for a brief moment here. On an equivalent basis, the S&Ps are actually trading here, not down here. So the tech sector, on a relative basis, equivalent basis to the S&Ps, are actually a little bit weaker, setting up this lower high, which once again sort of ties into the bearish narrative that I can see as of right now. Let's quickly go back to the hourly. I do want to throw on the intraday anchored view apps here, make sense of these really quickly. Again, you're getting confluence at the key level, which is at 423.50, coming from the low of the overall move. Opening below and rejecting that makes a lot of sense to me to look for that move in the downward direction. So that is your sort of confluence there. This is not quite aligned anymore with that 433.75, but again, the daily chart, I think it's just very, very obvious that this is overhead supply. It's continuing to look for a move in the downward direction. Let's take a quick peek at the market internals for the NASDAQ side of things here. We've already showed you the tutorial in the top right-hand corner, so you can reference that if you're interested. Generally speaking, there's not much of a divergence happening here between the NASDAQ and the S&Ps. You can still see decent volume inflows Monday, Tuesday, today, a little bit more neutral, trend higher zone here, a little bit weaker out of the advanced decline line today in the NASDAQ, and the tick on the cumulative side is also a little bit weaker today and not as strong on the Tuesday session, which I do think is noteworthy here. If we take a closer look at the market profile from the NQ, let's jump on over to this screen here. Again, you'll just notice, and this is a great illustration as well for relativity, right? You just never even got close to your single prints, whereas the S&Ps were testing this level today. It's not the case out of the NASDAQ. And if you're not familiar with the market profile, check out the video tutorial in the top right-hand corner. So the idea out of the market profile, just like in the S&Ps, is if we open underneath the previous day's low, you're looking for value to progress back in the downward direction. Ideally, you would actually just see value underneath this zone right here, which is that 17.5 level we've been describing in the pre-market preps. If value ends up developing here, I would be thinking about at minimum an equal low, if not possibly continuation, but being very cautious of this level based on the weekly analysis that we had just performed. Let's go back on over to the platform and let's finish up the broad market with the IWM, and then we'll take a brief glance through some of the supporting evidence. I know that the feedback in the comments has been pretty positive on the shorter videos, so we're going to try that out today as well. Here we go. Out of IWM on the daily time frame chart, the trend is clearly down. You could even make the argument, again, let's traverse some time frames here to the weekly. You could make the argument that the head and shoulders is starting to emerge, maybe even as a man ray pattern on the daily time frame chart. And again, let's clarify for the comment section, it's not manta ray, it's man ray. All right, so if we go on down to the daily chart, now that we understand the weekly, right, this line in the sand is major. Just for those who maybe don't remember what it represents, it's the top of the multi-year weekly balance range. And just as a quick proxy, let's go XRT. This is obviously underneath that same equivalent zone. And if we go XBI, continuing to, please do not lose sight of these charts because they're going to help you navigate whether or not small caps are likely to return back over the balance ranges, right? So anyways, let's go back on over to the IWM, and if we quickly drop it back to the daily time frame chart, your man ray pattern just simply involves, right, here's your swooped head, now you're looking for that right shoulder underneath the weekly line in the sand at 200. So the only saving grace I can sort of see out of IWM is that obviously it's not going to be impacted by your metaverse earnings. The tech sector is just not included in small caps here, at least out of the Russell, right? So if we're thinking about what this means, I mean, structurally, I would still very much so want to be mindful of the possible lower high rejection up against this 199, but notice in the post market, I mean, we're just 30 cents lower. It's not like we're opening on a gap down. There's no intent of being below this inflection point right here. If we're consolidating here, I would prefer to encourage you to keep a more neutral outlook out of the Russell. Again, I'm not saying that we're just going to clear this and it's going to be all fine and dandy. We're going to make new all-time highs and everything's going to be great in the S&Ps, but I would have to maintain a little bit more of a neutral stance if we're over 196.50 out of the Russell into the end of this week. As of right now, this is actually a bullish 3-bar play that's set up on the daily time frame chart, where if we can clear these two equal highs, we're looking for a bit of a thin structure retracement through this block, right, to the daily 50 SMA, and the next level overhead is at 203. One of the sort of concessions I would make here is just that would be a massive extension through the upper edge of the weekly expected move. So based on an odds and probabilities perspective, it seems like lower probabilities of that taking place into the end of the week. But once again, I would have to be a little bit more neutral if we're consolidating over this level right here at 196.50. If we take it on down to the hourly chart, we've still got those anchored view apps up. This is actually the neckline of a very sloppy but there inverted head and shoulders, right? Even if you wanted to consider this a balance range, look below and fail, not only did we hit the top of the range, but we've broken out over the top of the range. We did see a thin structure retracement today, so keep in mind that this rally from Tuesday morning, that was thin structure. So the market did what it was supposed to do. It broke down through that area quite easily, and then we saw a little bit of a rebound off of this zone at 196.50. So if anything, we're starting to think about the odds of a possible low and higher low here. And if this acts as a higher low, if we can get this consolidation and break up and over the weekly line in the sand, once again, that's going to remove some of the pressure from your S&P 500, even if the NASDAQ is breaking down. One of the things we've been saying around the channel is that the NASDAQ's likely going to act as your directional plus or minus, up or down, and then your small caps are going to be the fuel on the fire. If the two are in sync, so if small caps and the NASDAQ are moving in sync, they're both up, great. The S&Ps are going to have an easy time moving in the upward direction. If they're divergent, let's say that the NASDAQ is up, but the sort of small caps Russell is down, you're going to get a little bit more of a choppy move out of the S&P, right? And the same is true but opposite in the downward direction. So understanding that, once again, I've got to take this as a serious data point out of the Russell for the opportunity for neutrality. Now, if tomorrow morning we just, the markets open up, we get consolidation here, and we break and lower high underneath 196.50, let's call this for what it is. Let's call a spade a spade. Going back to the daily time frame chart, this is just a lower high. On the weekly chart even, it's just a massive lower high underneath that line in the sand. So let's not get head over heels about this being neutral and, oh my goodness, it's going to be our savior. We're not there yet, but if we're in here, you've got to at least consider that opportunity. Let's move on over to our Russell internals, see if there's anything different to glean out of these. Not so much. I mean, we still had the decent Monday and Tuesday neutral today, decent Monday, Tuesday, sort of mildly down today. I would point out here, and perhaps this skews a little bit more bearish, right? If you look at the Tuesday, when that rally took place, if we take a look at the futures here just briefly, this is where that thin structure, I would call it, I don't know about fully short squeeze, but as the market was ripping in the upward direction out of Russell, I mean, the tick did not participate. You got sort of positive off the open and then just went sideways into the close, even negative, not negative, but flat into the close here. So if we're trying to gauge the strength of the actual buyers on the Tuesday session, I wouldn't feel confident in terms of saying, oh my goodness, they're here. Buyers are showing up en masse to buy up small caps and send this thing back to all-time highs. We'll quickly touch on the market profile out of the Russell, and then we'll jump on into some more supporting evidence. We'll be brief in that section of the video, again, to sort of achieve some of the feedback goals from the comments section. I think that this has been a useful dialogue for myself as well. In terms of the small caps on the Russell futures here via the market profile, I think the inverted head and shoulders becomes abundantly clear as to what we were just talking about, or even just the, look below and fail that we were just discussing. So if tomorrow value is in here, again, it has to strike me as neutral, or at least a small progression in the upward direction. If value breaks down underneath 1995, that's the neckline we've been talking about, right? 1995, 1990, you can throw it back to the 90s, all the 90s kids out there. So if we're over that, if value is in here, neutral. If tomorrow we get the break and lower high underneath, if value progresses in the downward direction. So let's give you an example, just because I want to be very clear about the market profile. It's a really useful tool that I think, we tend to simplify here. But anyways, if we're doing something like this, right, let's just use this zone. If there's a big string of single prints tomorrow that print down here, but value is actually up here, then I would not consider that a noteworthy breakdown. This, to me, is just liquidation break and actually progress to contain us in this area right here. It's proof that stronger sellers are not stepping up. So if there's a breakdown in the morning and yet some sort of recovery effort into the afternoon that recaptures the level with value printing up here, that would be the noteworthy takeaway out of the Russell small caps from a market profile point of view. So that has been the broad market in a nutshell. Let's take a look now at some supporting evidence. We'll begin this segment with some notable concerns out of the S&P sectors, and ironically, we're not going to start with a sector, but rather the SMH Semiconductor ETF. If we take a look at this level right here, it's the 212 mark. This could be perceived as a weekly double top neckline, and notice that this morning's gap up completely failed against that level. If this sets a lower high, of course, that's a headwind for your S&P 500. The trend here remains in the downward direction, so 212 is your key inflection point. If we take a look at the XLY, you can also see that we do have ourselves a double top, and we're not even close to the neckline retest. So even if we do continue in the upward direction, the offering of a lower high is there, and that, of course, is bearish for your S&P 500. If we reverse down here into these equal lows, obviously downward pressure as well. We are not out of the woods in these heavier weight risk-on sectors. Speaking of the heaviest weight risk-on sector, here's the XLK, obviously very similar to our QQQs that we were just checking in on. You can see the offering of a lower high, very likely via a gap down tomorrow morning based on Meta's earnings so far. Any acceptance underneath 197.50 has to be downward pressure aiming for basically an equal low here. I would only be willing to change my tone if we can break out over today's high, find a higher low, and get the stronger counter trend move into 203.90. But as we've already described, this seems like a lower odds or lower probability into the end of this week. Moving along to the XLU, what's happening in utilities, notoriously a D for defensive and lightweight sector. Notice that the uptrend here is very much so intact with higher lows, higher highs, and even a higher high on today's session. So is it fair to say that a risk-off rotation is underway? I think the answer to that question is absolutely. That's going to make it more difficult for, quote, easy longs in your S&P 500, right? So this is a headwind for the market. Let's take a look at the energy sector. This is finding a higher low over the monthly breakout point, so maybe an issue for inflation, but it's a lightweight sector, not overly concerned here. Let's move along to the XLP. Once again, this is a classic D for defensive and lighter weight sector. What do we see from a trend point of view? It's really worth walking through here that there was no offering of a lower high on the retest of the bear flag breakdown point. There was no offering of a lower high here at the bottom of the overhead balance range at 75. Instead, we're not all the way to an equal high, but we're pretty darn close. So once again, if we're thinking about a risk-off rotation, the answer, again, seems to be yes. Let's move along to real estate. This is breaking down. I wouldn't be surprised to see a new swing low. A swing low is where we become more concerned. And the reason for that, of course, is that it's rate sensitive, and rates don't appear to be backing down anytime soon. Let's move along to financials, because financials is where we do have to give a little bit of credit where credit is due. So like the XLP, there's no offering of a lower high here up against the retest of this inflection point. However, we're not all the way out of the woods. There's still this 4120 zone. I do like the double inside bar here, or just high and tight consolidation, basically, where if we can break those two equal highs, it might alleviate some of the downward pressure in the S&Ps that we're expecting here. So I would really pay attention to financials into the end of this week, and specifically this 4120 zone. If we're over it with acceptance, thinking about bullish pressure, or at least alleviation in the S&Ps. If we break and then fail back down underneath, that starts to become a concern for, obviously, a big time daily lower high. So financials, in my view, really hold the key into the end of this week. Here's the XLV. It, of course, never broke down underneath this massive shelf, a flush point as we call it, but there's now the offering of a possible lower high here. Are we getting high and tight consolidation? Technically, the answer is yes. Even if this does break in the upward direction, there's an offering of another weekly lower high here at 143.20. I would only change my tone for a daily reversal if this is ultimately going to act as an inverted head and shoulders, and we're just not there yet. We would need the higher low over 141.30. So not out of the woods, but could be constructive if we get this. In my view, financials will be much more important than the healthcare sector for the end of this week, specifically in the S&P. Moving along to communications, obviously going to get completely whacked based on, of course, metaverse. You can see it's gapping down to 77.09 by 78, so pretty spready in the post market, but getting down towards this gap area over here. Obviously, that's going to be a massive lower low, and the offering of a gap fill reversal is just a lower high. That's a concern for your markets. XLI industrial is about 8% still of the S&P. We'll make note if it's over this level, it'll be a little bit more of a neutral data point, but not going to make or break us. Then materials as the lightest weight sector, continuing this mild drift in the downward direction is certainly not helpful for a market trying to get in gear for any sort of reversal. So the sectors do support more of a bearish stance in my view. If you take a look at the XLK, well underneath a downward sloping now 50 SMA, a little bit of a counter trend move, but just an offering of a lower high is abundantly clear anywhere underneath that 50 SMA. Here's where we had to give credit where credit is due. Financials, again, watching that level very, very closely. Financials hold the key. I think that this chart really speaks directly to that. If you look at the healthcare sector, still a counter trend move underneath the 50 SMA. XLY, it has not pulled its weight for a very, very long time at this point. If we're looking at the risk off sectors, XLP breaking out here, XLU continuing its trend here, that again is supportive of the risk off rotation, which is bearish for the S&P market. Let's move into some specialized ratios very quickly. This breaking down is bearish, or at least risk off. Let's take a look at this one, bearish and risk off. Let's take a look at this one. Apples to apples has even gone bearish and risk off here towards the bottom end of the range. Remember that this has really been stubborn. Consolidation here, consolidation here. It's finally made a move, and this is more of a risk off style move. So that is not supportive of a bullish thesis. In the S&Ps, let's go on over to SMH XLV, also more risk off, looking for this lower high and a rotation to continue in the downward direction. So sectors as a whole, not really supporting a solid reversal just yet in the upward direction. Here's the dollar, continues to get bullish consolidation into a flag up here. So it makes sense that we've seen a counter trend as the dollar is ever so slightly in the downward direction, alleviating some pressure on markets. But really nothing to write home about. It's not like it's broken down aggressively. Gold moving lower here should put upward pressure on the dollar ever so slightly. So if this pullback continues, look for the dollar to continue to heat up. And if we take a look at interest rates, again, you shouldn't be surprised when I show you that we're just in a bull flag out of the 10-year right? So, if this breaks out, let's actually take a look. This is a very interesting inflection point. I would actually be watching this a little bit more closely than I have been. The old chart probably had it on Thinkorswim before they updated. But anyways, over 4.68. Over 4.68, not that we would classically be looking for a gap close, but equal highs up around 5%. I mean, again, I don't see a world in which interest rates back down aggressively, as the Fed has sort of said, all right, we're coming around to the idea that inflation has stagnated a little bit, if not even starting to reaccelerate in the upward direction. So watching the TNX quite closely based on that, and this is a headwind for the market. Here's the 2-year. Of course, as this starts to break up and over this, it would indicate that the Fed is likely to stay higher for longer. Let's actually quickly take a brief look at some of the fundamental data points. Here is the economic calendar. We haven't received anything groundbreaking this week. I do believe that tomorrow morning at 8:30, the advanced GDP and unemployment claims will be fairly insightful. And then PCE on Friday at 8:30 is going to be interesting as well. This shouldn't really come as a shocker, considering everybody knows that the CPI for March was incredibly hot. I'd be more curious to see if the labor market starts to budge tomorrow morning at 8:30. We'll have coffee and donuts up in the penthouse studios in the suites. You can come out and we'll see the live market reaction at that time frame. So we're expecting 214,000. It's been very, very stable. So you're not going to see an aggressive, oh my goodness, recession call unless this really starts to accelerate up and over 250,000. It's just not even close at this point in time. If we take a look at the Fed tracker tool, this is completely reflective of everything that we've just described, basically how inflation remains stable and hot almost, reaccelerating, while the labor market is really robust. So still expecting that higher for longer pause here out of the Fed tracker tool. If we move on over to the earnings calendar, we of course know that Meta just reported after the close. It's not going so hot. And tomorrow, some heavy hitters. We'll throw in some lower tier tech, Snapchat, Roku. But it's really all about Microsoft and Google tomorrow after the close. Keep your wits about you for that one. Also curious to see how the world's most expensive burrito did. Chipotle reported after the close today. Perhaps we'll take a look at that in a brief moment. But for now, we'll finish up our risk appetite charts. The TLT ratio to the S&P continues to drift in the downward direction. So at face value, this is saying, there's no flight to safety trade unfolding. But if you look a little bit further, the bonds in relationship to themselves, these uptrends are starting to become, at first it was like, okay, this is a counter trend move in the context of this. But as we've continued to consolidate and build out these higher lows and higher highs, it's too hard to ignore as like this is a risk off data point. There's no preference for long dated risk as of right now in the marketplace. And you can also see this if you look at credit spreads, right? We've talked about this being too hard to ignore. If I just reduce this one a little bit and come up with this one, this uptrend off the lows, it's still offering a higher low. So yes, although it is pulling back aggressively, you're still getting the opportunity for a higher low coming from the highest high in the most recent trend count. So don't rule out credit spreads. This is still something to keep a pulse on for the strength or weakness of the market. Here are the high yield junk bonds in isolation, looking for the lower high. So again, if we're trying to remain bearish, if we're looking for the daily trend to continue in the downward direction, looking for this breakdown, this is incredibly nuanced, but something maybe worth paying attention to. Notice the lower high into the close of today's session, whereas the S&Ps got the equal high. So did the bond market know maybe that Meta was going to be, reporting poorly? I wouldn't go that far out on a limb, but there was a small and minor bearish divergence headed into today's close. Bitcoin's not doing much, but I do want to show you new highs versus lows on the daily time frame chart. We'll be a little bit more selective with the data points here. So we've gone positive, which, at first glance might be, oh my goodness, positive. This is looking really good. But remember, the August top from back here also went positive before flipping negative once again into those October lows. So I would not say that this is, oh my goodness, we're out of the woods. Markets are about to rebound back into all-time highs. So just understand that this type of dynamic can exist. And if we find ourselves negative into the close of this week, that would be a large concern. The other thing that is concerning is the SPX A50R offering a lower high opportunity underneath the 50% mark. That, of course, is bearish in terms of breadth as well. And here's the RSP, right? So sure, we got our counter trend move. We didn't make the lower low on the Friday session of last week, but what are we coming into? We're coming into a known area of resistance. And again, I wouldn't be surprised tomorrow if Metaverse hangs on this a little bit. It's equal weight, obviously. So Metaverse is not going to be the only name to bring it down. But if markets are lower tomorrow, the lower high is making sense off of a reasonable structure here. Let's move directly into volatility. Volatility, I want to point out, again, the mirror image of what we had during the sort of August topping formation, if you will. Volatility accelerated, came back down underneath 15 and then re-accelerated, right? The reason I want to bring that up is because if we take a look at the equivalent via the VVIX, let's go on over to this menu here, VVIX, it's the same thing. Here is your August, like, oh my goodness, things are starting to change, right? We come down back into like complacency zone and then we re-accelerate again. So, although yes, it was helpful in terms of picking off the divergence into the Friday close of last week, I don't think we're out of the woods. We've seen examples of this in the past where once you get a first breach, doesn't necessarily mean that you're free and clear. One breach, two breach, three breach, 4, 5. It's only once you've spent a substantial period underneath where it's like, okay, this high didn't make it there, this high didn't make it there, this high didn't make it there, right? That's where we're a little bit more comfortable and complacent, looking for the market to trend. These spikes start to indicate that there's been a change in tone, right? There has been a change in tone. We are no longer stable. Things are actually getting unstable. If we look at the one-day VIX, this would sort of mirror that as well. Down below here, this consolidation over 1275, that's where the market starts to really see some issues. So if we can remain on a lower high underneath the one-day VIX at 1275 and do something that looks like this into the future, that would feel a little bit more comfortable for the market trying to work out the kinks of volatility. But as of right now, the close was actually above. So this to me is just indicative of maybe a higher low happening in here. If we start to continue to see consolidation up there, we're not out of the woods. So you really got to see that flooring activity, if you will, down towards 745, 750, if the volatility issue is going to be resolved. So as of right now, this also strikes me as a minor headwind for the market. We'll kick off the core list of companies with Apple on the hourly time frame chart. And before we talk about price action, I do want to make note that there is an incredible amount of relative strength taking place in the post-market, seemingly not affected by Meta's earnings right now. We're trading 169.11 by 20 on the bid-ask spread there, so right near the highs of today's session. If we're looking for shorts, which in my opinion is the ideal trade to be thinking about, we want to break down under 169, catch the lower high underneath on a 5 or 15 minute chart, and your target would be the retest of the breakout point here at 167. The idea would be to spot risk reward on some sort of setup that looks something like this. That's the ideal short trade into the end of this week. If we're consolidating over 169, I'm not thrilled about taking any directional trades in this zone right here. And the better longs, in my view, are really looking for a break and higher low over 170.50 for a thin structure retracement. The reason we're not thrilled about longs, even if we're just over 169, is because if we take a look at the daily time frame chart, we know that there's a staggering amount of general weakness out of Apple. Obviously not right now in the post market, but there's still an offering of a possible lower high here. So even if you do get this move, I mean, this is a lower high. If you get this break that we just talked about, I would be thinking about the daily lower high up against that target at 173.75 and the daily 50 SMA. Moving along to Microsoft, quick disclaimer here. Microsoft is going to report earnings after the close tomorrow, so it's not really worth trading the options contracts, in my view, for the Friday expiration. I don't intend on doing anything aggressive in Microsoft tomorrow. Implied volatility is off the chain. So you could take a look at the levels we have mapped out here. If you're intent on doing something, those are the numbers that I would use, but I don't see anything obvious. I mean, this is moving in the downward direction on Meta's earnings. So we have 401.50 by 90 basically in the post market. We're trading somewhere down here towards these equal lows. I think the threat becomes that if on earnings, like if Microsoft's earnings themselves are also not stellar, or if expectations are missed, they could be great numbers, but they miss expectations, right? We're not talking about the coin flip, but if it's lower on earnings and this breaks, suddenly this looks like a massive range that's stuck as overhead supply. Huge opportunities for lower highs. So just general risks out of Microsoft right now look something like that if earnings don't go stellar and we end up with an additional gap down after the close tomorrow. Moving along to Google, a lot of the same commentary over here. Earnings after the close on the Thursday session. The only interesting note out of Google is that intraday, I might be willing to take a stab long if there's some sort of break up and into blue sky territories. What's the issue with that? Obviously, of course, based on the Meta earnings, we're trading 154 by 154.15, which puts us, loosely down here somewhere. So I don't necessarily think that that is going to be in play unless there's a miraculous recovery effort ahead of the open. Again, seems like lower odds, but if we're up here, yeah, I might be willing to take a crack ahead of earnings. Other than that, not really interested, but once again, you can catch the levels if you'd like. Here is Amazon. Earnings are further out on this one. So if you're looking for a play that is not going to be impacted by earnings, you can clearly see it is moving lower based on Meta, 172 by 172.26. So we'll be opening somewhere down here, but the gap fill reversal becomes more interesting, right? Because we don't have to deal with the IV. That's something for next week. So I'd still probably trade Friday's expirations to avoid the sort of earnings gamble that starts to get priced in to some of those options contracts for next week. So gap fill reversals make sense out of Amazon. Let's take it down to an hourly time frame chart. I think it was a very clear lower high around 180. The trend is obviously down here. Bear flag. I mean, we're opening underneath. So gap fill reversals make a lot of sense to me. You could see a relief rally out of it. Just because it was not directly tied to Amazon's earnings yet. So something that does this, again, just because this is further out to next week, this is probably more of a contender compared to Microsoft or Google. Here's NVIDIA. NVIDIA is always way further out on the spectrum in terms of earnings, so not really an issue on that front. In terms of the trade setup, though, a beautiful lower high. Again, this is one of the things we talked about in the pre-market prep. This gap up should not have fooled anyone if you tuned in. I mean, we talked about how this, on the daily chart, is massive overhead supply. Retest the 50 SMA. I mean, the SMH as a proxy basically showed us the same exact setup, right? Up against that 212. So bearish engulfer prints on the daily time frame chart. I think you're just looking for a continuation move in the downward direction. Post-market, we're 787, let's just call it for round numbers' sake. 787 puts us somewhere in here. So very minor gap down as of right now. I think we're aiming for the equal lows basically. So on the hourly time frame chart, to take a quick peek, the idea would be on an open gap down, you're just looking for rejections as long as they're underneath 802.85. So it's this opening print from that day right here. It's the small gap fill reversal from the Tuesday session. It's also this support intraday today. Any lower highs beneath that level set up the short into this zone right here. So if you get this, right, you're looking to set up risk reward, something that does this, trading back down into the equal lows, which are at 772.25. It's a gap. If it's a gap and go, in the downward direction, I mean, you probably want to be patient for another confirmation down here. I would not want to just be directly short, dead on the lows of the overall move. I mean, maybe you're getting a little bit of an equal low breakdown. You are getting technically an H pattern in here. It's possible you see continuation, but just be mindful of your risk reward if you're entering, right on the number at 772.25. Goodness, the price points of these things are getting unbelievable. Here's AMD. What do we see out of the daily time frame chart? Breaking down from the head and shoulders. Great offering of a lower high here. A lot of the same. Let's actually take it back down to the hourly. You'll notice that there was no gap fill reversal for something that did this, so that is not constructive. The only time I would say, okay, maybe there's an offering of like inverted head and shoulders is if there's a higher low over that 154. Doesn't look likely as of right now. Post market is 149.50 by 70. So any consolidation here, I think that this is actually an attractive short into the end of the week. If we can spot the risk reward setup that offers something that does this, there's your trade, right? On the downside. The long side, as we mentioned, has to do something like this. And even at that, I would probably be more interested on a break of what would seemingly be the neckline at that point of an inverted head and shoulders, right? Next up, we've got Metaverse. Speaking of the devil, let's flip on the extended hour session and see the damage that has been done. So we're just going to go ahead and do something that looks like this, and we're going to keep you posted on the update for tomorrow morning's pre-market prep. It's really not worth doing any analysis on as of right now. I guess we can quickly flip on out to the daily time frame chart. Where are we in relationship to the previous earnings gap is noteworthy. We're inside of it at 417 currently. So my goodness, when I measured, we were 435. So we're definitely down over 10% from when I first mentioned that in the intro. We're basically opening like somewhere in here, well through this previous earnings gap. So I think that you're going to get a lot of push and pull tomorrow morning. I don't think that this is going to be an easy trade to pull off until some structure has actually built out. So we'll give you a recap when the trade setup starts to emerge. And as of right now, it's just not really there. Let's move along to Tesla, which is very disappointing for a lot of folks. A lot of people are like, give me your opinion on Meta. It's gapping down big time. You guys know me. The most repeatable trades are under normal market conditions, right? This whole earnings gap thing, all it takes is one trade to break it all. You're not going to make a boatload of money or, make a career in one trade. So I'll leave you with that bit of parting advice on earnings trades. But anyways, what do we see out of Tesla? At least when it comes to options traders, I mean, who knows? If you're holding shares, of course there are ways to do it. But for us options traders, not really something that we want to get wrapped up in. Anyways, here we go with Tesla. The offering of a possible, I don't want to call it look below and fail because this is not a failure. That was a successful move in the downward direction, certainly doubling the range there. But if we can stay over this 161.25, I would think that a short squeeze might be underway. If we take a look at the hourly time frame chart, let's go back off with those extended hours and see what we can see. Really sporadic on the opening hourly bar. So just like what we were sort of suggesting or hinting at out of Meta, I don't think we have enough structure yet. I would say that if we're over 161.25, I would be more partial in the upward direction, of course, because we're getting back into this range. If we're under 161.25, I would be thinking about the opportunity for the gap to close. So just a lower high underneath this 158.15. It's very interesting how the low of today's session is the high of this previous consolidation range. So if we were to break that lower high underneath, you could look for this gap to close. That would be 154, 152.25 as a target. Then the full gap close for the Tuesday high is at 147.15. So Tesla really taking this one in stride, almost identical to Netflix, not in terms of like the chart pattern, but just taking it in stride. I mean, the only attractive setup that was offered here was the look below and fail, and not 1% of my brain thought that this was going to go directly back to the high of the range in one day's session. I mean, just unbelievable moves recently out of Netflix. It's like someone flipped the volatility switch probably ever since here. Just all these round trips. It's really become something that's not very attractive to trade. If you can tame the beast, then be my guest. But as of right now, the core list is it's really not offering much of a beautiful setup across the board. I would say Apple's interesting. Google all-time highs maybe. Amazon's kind of NVDA looks good for maybe that lower high setup. AMD, same thing. Metaverse is on the back burner. Tesla's on the back burner, and Netflix is on the back burner. So that's why I've got 3.5 trade ideas for you to end out the video. COP, ConocoPhillips, what do we see? We know that the energy sector as a whole is pulling back into some big retest areas. Same thing here out of COP. Earnings are not a concern as of right now. Multiple inside bars on the daily time frame chart. If we were to get a break up and over these highs, looking for the equal high here, so let's find that on the hourly side of things. That would be up and over 130.25. If we can get up and over 130.25, looking for a move back up to the equal highs, and your target would be at 134. So COP, longs over 130.25, neutral through here, off the table if we're underneath 127.25. Next up, we've got Disney. What's going on with DIS? Disney is not tech related, so you're not seeing aggressive moves in the downward direction in the post market. Here it is on the daily time frame chart. I want to give you the context of the daily first, being tangled up around the 50 SMA. Earnings gap up. Earnings are not a concern on this one either. So not really concerned about that yet, but looking for this as an inverted head and shoulders to support off of the daily 50 SMA. On the hourly chart, this emerges as a trade into the end of this week. If we can get a breakout up and over 114.35, clear that 50 SMA, something that does this is a thin structure retracement. And then yes, we do have to contend with possible resistance at 116.40. But as a trade, I mean, there's 2 points for you out of Disney, which is still sub 125. So certainly worth watching for out of DIS. And then here's the 3.5. We've got GS, Goldman Sachs, as a bull flag here. Look at the inside bar. So bullish 3-bar play basically into all-time highs. Over 425.17. Let me just double check and make sure that this is all-time highs. Yes, it is. It is all-time highs. If we can crack that, bullish 3-bar play on the daily chart into all-time highs, rebounding out of this monthly double bottom. I mean, this is just a huge, like you could even go this far and say like maybe this turns into a cup and handle. There are a number of different patterns to suggest here out of Goldman Sachs, but overall, the chart structure, I mean, there's a clear way to manage risk into those blue sky territories. You can put a stop directly underneath that low, consolidation, break higher low, and you're trading into blue sky territories, which really means $1.5 intraday levels that form as your only levels of resistance, right? You'll also notice, if I'm just realizing this in real time, that this prior high is actually the low of today's inside bar. We know that financials as a sector overall are really the only ones holding up with some semblance of relative strength in the risk-on cohort. So that's GS, and then it's 3.5 because we've got MS as well, Morgan Stanley as another financial contender. So it's not identical, it's not the same exact setup, but the thesis, the spirit of the trade is generally the same. You've got an inside bar pressed up against this known area of resistance here at 94. Let's go 20 on that. 94.20, you guys know the rules up here in the penthouse, round numbers only. So if we can break out over that, this one I do not believe is at all-time highs. So let's do something like this. Monthly chart will do it. Let's go weekly. And here we go. You're probably looking for a target up against, if you extend this to the left, that's the same high. So you're looking for the open of that breakdown bar there, loosely around, let's go 98.60. 98.60 as a possible upside target. And that is going to do it for today's episode of the Midweek Market Update in a slightly updated format. I think we've sort of found the blend. You guys can let me know down below in the comment section what you think. But I think that this is an appropriate blend of still touching on the reasonable data points, expediting the supporting evidence a little bit, and still including some trade ideas and a look through the core list of companies. So let me know what you think. I'd love to hear from you guys down below in the comment section. Once again, we will be live tomorrow morning at 8:30. The coffee and donuts for the advanced GDP release at 8:30. We'll start the stream at 8:15. We'll see the live market reaction and take it in stride from there. Don't forget 100K by May. We're likely not going to hit it, but let's see how much damage we can do ahead of the calendar flip. With that said, everybody have a green rest of your week, and I will see you in the next one.